By the first quarter of 2026, Berkshire Hathaway amassed a cash and short-term treasury stockpile of $397.4 billion. By nearly every historical metric, stocks have entered a zone of extreme overvaluation. This is the Buffett indicator, the ratio of total U.S. market capitalization to GDP. It climbed to 227% in 2026. Buffett categorizes a reading above 120% as overvalued. At 227%, it surpasses the peaks of the dot-com bubble and the 2008 crash. The yield spread measures this disconnect. The S&P 500 offers an earnings yield of 4.76%. A 10-year Treasury provides a risk-free return of 4.3%. This leaves a 0.46% spread, offering investors no extra compensation for stock market risk. With that math in mind, holding $338 billion in government treasuries is a strategic choice. The risk-free rate is simply more attractive than the returns offered by overpriced equities. Beyond valuation, mechanical factors are accelerating the sell-off, specifically the Corporate Alternative Minimum Tax, or CAMT. To avoid penalties on billions in unrealized book income, Berkshire is realizing gains on long-held assets like Apple. This ensures their cash tax payments meet the required 15% threshold. These internal tax maneuvers are happening against a backdrop of increasing market fragility. Buffett has criticized the explosion of one-day options and speculative betting, describing the current environment as a casino. That fragility is compounded by geopolitical shocks. With the Strait of Hormuz blocked, a fifth of global oil supply is gridlocked, driving up energy costs. Even the housing market is signaling a shift. Berkshire's real estate division recently identified a great housing reset, with homes sitting on the market longer than at any point in the last 6 years, as 6% mortgage rates freeze buyer activity. Between rigid tax mechanics, speculative market options, and global supply chain disruptions, Berkshire is positioning itself for a market that is increasingly vulnerable to a sudden deleveraging event. It's tempting to assume Berkshire is repeating its 2008 strategy, but the timing is different. In 2008, Berkshire was in the deployment phase. They acted as a lender of last resort, injecting billions into the system when liquidity had evaporated. The current $397 billion accumulation mirrors 2006 and 2007. This is the pre-crisis phase, the period of disciplined waiting before a major market dislocation occurs. This strategy remains consistent under CEO Greg Abel, who has transitioned the firm toward a team-based leadership structure while maintaining Buffett's core capital allocation principles. Abel has characterized this massive cash reserve as ammunition, providing the firm with the flexibility to act when others are forced to sell. They are waiting for what Buffett calls a hair curler event, a moment of panicked, dislocated selling that offers the high-quality assets they prefer at sensible prices. By building a $397 billion reserve, Berkshire is demonstrating that the conditions for safe, large-scale investment do not currently exist. In a market where the risk premium has vanished, they have chosen to wait for the crash rather than pay the price of admission.